Dive deeper into each component of the under 5 strategy in the derived digit market. I will break down each section so you have a comprehensive understanding of how each piece works together to make this strategy effective. Here is a more detailed look at each element. Here is the text to convert. 1. Understanding bar positioning, green versus red bar. The positioning of green and red bars provides a visual gauge of where recent digit outcomes have been, which helps in predicting whether the next digit might fall under 5. Green bar represents the probability of recent digit results falling below 5. When the green bar appears on the left side of the red bar and shows values at or below 5, it signals that recent ticks tend to stay under 5. Red bar represents the probability of recent digit results falling above 5. When this red bar appears on the right side of the green bar and shows values above 5, it confirms that recent market movement has been tilted towards digits over 5. Ideal condition for entry. Look for the green bar to be positioned below 5 and preferably at 4. This positioning indicates a more stable environment with a higher probability of upcoming digits also staying under 5. At the same time, you want the red bar to be positioned above 5 and preferably at 1. This shows that the market's bearish trend is supported by recent digit outcomes, making an under 5 prediction more reliable. Why this matters. The position of these bars gives a clear signal about recent digit patterns. A green bar positioned below 5 and a red bar above 5 creates an ideal setup for predicting a digit outcome under 5 because it indicates a market bias toward lower numbers. Here is the text to convert. 2. Using the MACD indicator for trend confirmation. Moving average convergence divergence, abbreviated as MACD, is a powerful trend-following tool that helps confirm market direction, adding reliability to your entry. MACD line and signal line. MACD line crossing below the signal line. This suggests bearish momentum, aligning with the under 5 trade approach. When the MACD line crosses below the signal line, it shows that downward momentum is increasing, supporting a prediction for digits under 5. Histogram bars. The histogram bars, small bars above or below the zero line on the MACD chart, help visualize the momentum strength. When the histogram bars are red and below the zero line, it means there is a continued downtrend, making it favorable to bet on lower outcomes, like under 5. How MACD confirms entry points. Use the MACD to confirm that there is enough momentum in the market to justify a low-digit outcome. If the MACD and signal line cross and the histogram is consistently red, the chances of getting a digit under 5 increase. Relying on MACD alongside the green and red bar positioning gives a clearer picture of market momentum, helping avoid trades based only on one factor. Here is the text to convert. 3. Analyzing candlestick patterns. Candlestick patterns visually depict market sentiment and momentum. When trading the under 5 strategy, focusing on red candlesticks can help you time your entries better. Why red candlesticks? Red candlesticks indicate that prices are trending down, which aligns with the under 5 strategy, as lower prices often correlate with lower tick digits. How to use candlesticks for entry confirmation. Look for a series of red candlesticks. When multiple red candles appear, it suggests sustained selling pressure. This selling pressure aligns well with an under 5 entry, as the market's sentiment is bearish. This candlestick confirmation provides visual support, confirming what moving average convergence divergence and bar positioning already suggest. Here is the text to convert. 4. Execution guidelines. Executing this strategy successfully means paying attention to the number of runs, entry timing, and expiry time. Number of runs, 5 to 8. Limiting runs to between 5 and 8 helps balance between capitalizing on a favorable market condition and avoiding overexposure. Too many runs increase the risk of hitting a reversal. Duration 1 minute. The short duration of 1 minute per run allows for quick entries and exits. The under 5 strategy capitalizes on short-term fluctuations, and 1 minute is typically enough to catch these small market movements. Expiry time minutes. In cases where market stability is in question, setting an expiry time of 5 minutes provides additional flexibility. If conditions change, the trade is still active for a brief period, giving it a chance to meet the conditions again before closing. Here is the text to convert. 5-point. Putting it all together, step-by-step execution. Now that you understand each component, here is how to execute the strategy effectively. 1. Observe the bar positioning. Ensure the green bar is positioned at or below 4 and to the left of the red bar. Confirm the red bar is positioned above 5 and ideally at 1. 2. Check MACD for momentum confirmation. Verify that the MACD line is below the signal line. Confirm that the histogram bars are red and below the 0 line. 3-point. Analyze the candlestick pattern. Look for consecutive red candlesticks that indicate bearish momentum. If the red candlesticks continue, this reinforces the downward momentum, making it an ideal entry moment. 4-point. Positioning, moving average convergence divergence, and red candlestick confirmation. Initiate the trade with an under 5 entry point. Keep your runs limited to 5 to 8 and aim for 1-minute durations. If market conditions are volatile, use a 5-minute expiry for added safety. Here is the text to convert. Signal rationale, why this strategy works. Each element in this strategy is chosen to provide layers of confirmation. Bar positioning gives insight into recent digit trends, indicating whether the market is favoring lower digits. MACD ensures that the market momentum is aligned with an under 5 bias, avoiding false entries. Red candlestick patterns provide immediate visual cues of a bearish sentiment, which supports lower closing digits. By combining these indicators, this strategy minimizes reliance on any single factor. The layering of confirmations creates a stronger entry signal, increasing your probability of successful outcomes with under 5 trades in the derivative digit market.